Hey guys, what's up? This is Andrew for TrendLineses.com. So in this video, guys, I would like to make a big update on GameStop. We finally had a close above the major resistance trend line. So let's get into it. Alright guys, so it's looking very good, but it's not perfect. So let me go through everything that happened on Friday. Let's try to understand why we had this move up and what it means right now in terms of technicals. Are we bullish? Are we bearish? Of course, we are bullish on the medium term, but let's analyze exactly what is happening on the short term, what might happen this week and the week after that. We're gonna go through the option market, check the DTC, check the 950 strike. So we're gonna have a look at basically everything and try to anticipate what will happen. So first, you guys know this chart. I'm here using basic technical analysis tools like trend lines. I am in logarithmic scale just for you to see the difference. If you're not using the log scale, you can't see this trend line. So you have another trend line that you can make that gave you a reaction as well, but basically the reactions you're going to have using the logarithmic scale are going to be more reliable more trustful, but they will happen slightly later. So I prefer to do that whenever I have a stock that lost, around 50, even more compared to its peak, that lost, 70, 80%. It's better to use the log scale. So this is what I'm using. This is how I get my trend line. So let me put it back how it was. Bam. Okay, so this is what happened. We had this strong move up. So first thing, like I said, guys, in my previous video, we were trading, look at the moving averages usually. So first we arrived on that trend line on the 3rd of November. We had this huge run up. We got rejected. We closed below the trend line and below the 230 level. Why 230? Because it's the recent high. So it's as important as the trend line to me to know if we are starting a new move up. So here we got rejected. Fine. Then we retested it once, twice, 3 times, and then we corrected. Fair enough. But look at what happened. We didn't even touch the moving averages, which was for me a bullish signal that I told you guys, whenever bears are not able to reach the targets, it's bullish, So we had some good signals here before. Then we were grinding higher, and suddenly this huge move up on Friday. I checked the news, I didn't see anything. So we might try to understand where this is coming from. And for me, the reason is the technicals. I mean, we had this 200, basically 20 level that was here resistance. We went right through it. We also have the option expiry on that day, the November expiry. So the 220 strike there was some options there. You can check my previous videos. It was not huge. It was not immense, but still, whenever you go through a strike on the expiry day, you're going to have this momentum created by option market makers. And this is what happened here. But for me, the most important reason to have this huge run up is that we went through this resistance level, just like we did here, guys. Whenever we go through important levels, especially if you have some gamma, you have this kind of reactions. And what triggered this move up? This is another question, because we need to have the move up first to have then the momentum that is starting and push higher. So we know why we pushed higher once we have started, but why did we start? This is a good question. And I'm not sure. I just give you my feeling here is, on the expiry, people just roll their options, all right? If you have, for example, November 250 calls, you know that they're probably not going to finish in the money. So you are wondering, should I roll it to December or to January? And if yes, then on that day, you will close your November options expiring and you will open a new option on December or January, which means that basically you're going to buy shares. I mean, you're going to buy calls. Market makers are selling you calls and they're going to buy shares to hedge their positions against you. So this is the reason why on those expiring day, you have sometimes a bigger volume than usual. And here, I think it's a mix of everything. Option expiry, we went through the 220 strike that was, where we had some kind of substantial position on November and December, and we had this roll. So this is the situation. We went through so for me, the level was 220 roughly. So we closed above. Perfect. Very good. Do we have energy? So to know if we have energy, you can check Bollinger Bands RSI. Let's do it. Okay, we had energy here. As you can see, the RSI was below, around neutral, and we had this breakout at this level that I gave you guys, by the way. And then you can see the Bollinger Bands were tighter, and then we closed above the upper band. So here the situation is slightly different. As you can see, the Bollinger Bands are wider, and we arrive on the RSI that is close to be overbought. You guys know that when the RSI is overbought, for example here, it was overbought, we still took 50%, right? So it's not a signal, it's not a bearish signal when you have an overbought RSI. It just means that we are not in a setup when we are full of energy. Then next thing we can say, so we have analyzed the energy by using Bollinger Bands and RSI. I get rid of the Bollinger Bands, bam. Second thing, do we have some resistance close to us? Yes, we do. We have the 230 resistance. Why? Because it was the recent high. Let's check if we had some reactions on this 250 move here. Nothing clear, all right? So it was not acting here a little bit, okay? Almost 229, yeah, this is valid. So here one reaction. Let me go on the 15 minute time frame. I just want to check if it was used here. Yeah, you can see here a little bit, here, yes. Okay, so you can see here the 230 level was consolidating for 1 hour. Here we had one reaction, and here again one reaction, and here one reaction. So basically on the 15 minutes time frame, you have around 7-8 reactions in the past month. So it means this level is followed. We knew that, but it's always good to confirm it by checking really how investors react close to these levels. And here you can see that it's a level that buyers and sellers both use to enter or exit some positions. So it's an important level that we need to close above to look really good. So we are looking great, guys, okay? Let's be honest, but we are not looking perfect because we miss a little bit of energy and we have a resistance just on top of us. So what is my view? As usual, guys, I'm going to give you my view. You know, I'm going to give you two scenarios, my preferred scenario and the alternative scenario. So both scenarios are going to be bullish, but my preferred scenario, it's hard to say. Let's say it's a 50-50, but let's be bullish. And we're going to move higher, maybe correct a little bit, you know, and move into 5 waves like this, then correct, then go here and something like that. Okay, this is my bullish preferred scenario, all right? Is that we push higher, we need at some point to find some energy. Just look like here, we arrived strong, but second day was bullish after this huge gap up. Third day was bearish. We need sometimes to take back some energy. So either we do it right now or we're going to do it slightly later. I don't think we can run up to 350 without any pullback. I mean, there's going to be at least one pullback that can last 1 day or maybe 3 days. I don't know. But at some point, we need to take back some energy. So in the bullish case, most bullish case, we go right away to 250, then correct to 230, and then go higher. Just for you guys to know. So I'm personally involved in this trade, as most of you. So I had a position before, but let's say I added up here at 175 roughly. So here I bought some calls, sold some puts. Then here I swinged it a little bit. And here I just bought one little put. And what I'm going to do with it, so I'm still basically reducing my position by 30%. I'm not sacrificing any of my upside performance. I have calls and I keep it, because I don't want to sacrifice any of that by selling a higher call, which is something that I might be doing later, but it's much too early to do that. Also, we had a huge spike in volatility. I'm going to show you that very soon, but it's important. So for this reason, buying calls right now is maybe a bit risky, but makes sense. So my preferred scenario, yes, is that we go here. In this case, I would just sell my put on this pullback and probably buy more calls or do something. I don't know yet. In the alternative scenario, which is possible as well, is that we get rejected first, retest the trend line. But you guys know that most of the time we have those retests, so we can expect to have it here. And then we go higher, you know, and do a little bit the same thing. So I don't know, 50-50. Of course, we close the day at the highest level of the day. So this is bullish. So that's why I'm rather thinking we're going to open higher on Monday. But if we don't, guys, it's fine. And I'm personally going to use this level either to sell my put. So for sure to sell my put, I'm going to sell my put on the first pullback I see this week, even if it's higher. I don't care to lose a bit of premium. And yeah, so this is what I think will happen this week. Now, let's have a look, guys, at the option market. So I'm already on it. And as you can see, we monitor different things here. We are monitoring first, regular short, 12%, didn't move. Maybe I can find the next one right now. up. I'm checking it with you guys. I don't know if it's the 30s. Okay, so the regular short moved from 12 to 11%, so roughly stable. And the synthetic short is right now at 6.3%. Okay, so the DTC is at 4.8, so it's rather stable. We can see in the past month we are between 6 and 5, so we are already in an area where shorts are under pressure, where there is tension in the markets, where shorts need to trade 5 daily volume to cover all their short positions, which is a lot. So we have this tension. This is one more reason. Probably we had some stop losses activated here. I didn't mention that, but it's the same thing. Whenever you go through a breakout level, you have some buyers stepping in and you have some sellers that cut their position. They have a stop loss just above. So it's probably a domino effect as well on the stop losses that help to push the price higher, because we have a DTC at 5. So shorts know they need to have a stop loss somewhere because they can get squeezed. They're aware of this. So DTC at 4.8, and let's check the 950 strike. We were just above 4 million last time I checked. We are right now at 4.1 million shares equivalent on this level. It's absolutely insane compared to everything we have on the other strikes. For example, the biggest one is at 300 and we have 1.4 million shares. So we have around 3 times more options on the 950 strike than on the 300 strike. By the way, you can notice that the biggest strike, if I don't take into account the 950, usually is close to the money. So the money is at 229 right now. So we should have it at 250, but you can see the 250 strike, we have around 700,000 equivalent shares, whereas we have 1.4 million shares on the 300 strike. What does it tell us? It tells us, guys, that whenever we're going to go through this strike, shorts are going to get squeezed. Okay, it's going to amplify the move whenever we go through 300. So this is the reason why I believe that if we close above 230, we're going to need to test the 250 level. That is the most recent high. Even if we were there only 15 minutes or 1 hour, it's still the next resistance. So maybe here we're going to have some kind of a rejection. But here, it's a no man's land. As you see, guys, I don't have any resistance between 250 and 350. So I believe that once we trade above 250, it's going to be very volatile. Everything can happen, but most likely we're going to have this kind of bam, strong moves. Why? Because of the gamma. 300 strike is huge, and I'm pretty sure it's going to grow in the coming days. So one more thing I wanted to show you quickly, guys. If you go on options and you are wondering, is it better to have, for example, 240 calls? I'm on the January maturity, or is it better to have 300 calls? It's a good question, and I'm personally having some 240 calls. And I was wondering, should I roll it higher? All right. Should I get more leverage by buying a 300 call instead? And to know what is better, you just put the two strategies one against the other. So here I have my 240 call on the Jan 22 maturity for a premium of around $3,000. Now, if I sell it and I buy the same amount of premium on the 300 strike, I sell one call, I can buy 1.5. So you cannot trade 1.5, but let's say you have 2, then you need to buy 3. Basically, you can buy 50% more 300 calls than 240 calls for the same premium. Okay, should we do it? First, you check the volatility. You can see that the volatility is 50 points higher on the 300 strike. So you pay a higher premium to get this option. First thing, so it's not good in terms of volatility. 15 points is not small, it's quite a lot. So for this first reason, it's better not to do it. Then if you still want to do it, let's check the payoff of the difference, which is basically going to tell you whenever you would have been right to do it. If it's positive, it means that the 300 call strategy, once again for the same premium, is better. And you can see that we are positive above. So you check the blue trend line, the blue line, which is the payoff at maturity. So basically we start to be positive above 180%. So you would have been right to do it if GameStop trades above 410 in January. So it's not easy to answer, but I would personally keep my 240 call because it's a better volatility, and I would have been right to keep it if we are below 410. So I would just make a little bit less money if we are above. But you never know what's going to happen if we close at 350. which is possible as well, which is below 410, you would have been right to keep the 240. So to conclude on that, it's more conservative to have a lower strike. It gives you more flexibility to, for example, buy puts or do whatever you want. But if you really believe we're going to go to 800 right away, which is very possible as well, and if you want to play this scenario, you can see that, for example, whenever you, at 200%, for example, or even 300%, you make 12,000 US dollars more by having the 300 strike call. So this is the trade-off that you guys have. Once again, I personally prefer to have a lower strike and then a bit swing it. So that's it for today. I hope you guys enjoyed this video. I hope as well that we're going to see a crazy week on GME. This is pretty nice what is happening right now. We have the volumes, we have the breakout, we have the new high, we have everyone talking about it. So this is looking quite good to me. So I hope you guys enjoyed this video, and if you did, please don't forget to click on the sub, like and bell button so you're gonna be the first to know when I upload anything new, and stay close to shore. I see you guys.